If you've been feeling disappointed with your performance in 2024, or worse, if you've been watching from the sidelines as this incredible bull market passed you by over the last year or two, then you're in the right place. Let's dive into rule 1, identify an edge. So what do I mean by an edge? It's simple. An edge means finding assets that have a higher probability of returning a profit than a loss. Look at stocks like Fiserv, GoDaddy, FTAI Aviation, and Vistra. These aren't random picks. They've all climbed over 100% since 2023 through 2024. An edge comes from identifying the start of each trend, and I'm going to show you exactly how to do that. The simplest and most effective way to identify an edge and catch these 12 to 18-month trends is through chart analysis. Each of these winning stocks was identified using our 4-phase sequence method, or what we call the 4PS method for short. Every single stock and asset we invest in goes through 4 distinct phases. I apply this analysis to the monthly time frame because it gives us an incredible amount of information. Phase 1, identify a stock with a proven performance history. If a stock has performed well in the past, it's likely to perform well in the future. Phase 2, wait for a prolonged consolidation or base to form, typically 3 to 6 months. Phase 3 is a confirmation that the stock has broken out from that base. And then phase 4, enter the stock at the start of the next major uptrend. The monthly time frame tells us everything we need to know. The 4PS method is our systematic approach to identify and catch potentially profitable stock investments right at the start of their uptrend. GoDaddy, Fiserv, FTAI Aviation, and Vistra all entered phase 4 last year. As trend followers, we identified the edge, took positions, and rode these trends higher. Notice how all these stocks were creating all-time highs when they started their latest phase 4. This is crucial. It aligns perfectly with our trend following logic, which is buy high, sell higher. The stock is already moving in our favor. We want to take advantage of that. Now, here's something most investors don't appreciate. Stocks setting record highs typically move the fastest over 12 to 18 plus months because there's very little resistance above price to force the stock price down. Compare that to discounted stocks that have to fight through multiple resistance levels to move higher. I'm not interested in stocks that have to work that hard. I want profitable stocks moving through the path of least resistance. Let me share a pro tip here. There are around 20,000 stocks to choose from. This is a huge number. We use a scanner to create an initial shortlist of all the stocks moving from phase 3 to phase 4. Then use our bespoke charting tools to filter out the most promising candidates for our portfolio. This is how we found GoDaddy, Fiserv, FTAI Aviation, and Vistra, and all the other stocks in our portfolio. Remember this, if you cannot define your edge, you don't have one. And if you don't have an edge, you'll get eaten alive by someone who does. The 4PS method is a system I developed to remove emotions and guesswork, replacing them with a clear, objective approach to finding top stocks. It's yours now, take it and use it. Okay, so let's move on to rule 2. Wait for the right entry point. When you see a stock moving from phase 3 to phase 4, what we call a breakout, resist that urge to jump in immediately. Being eager will cost you money. Remember, patience pays dividends, and I mean that quite literally. After consolidation periods longer than 3 months, fake breakouts are more common than you might think. But here's the good news. These fake breakouts can be avoided with what I call prepared patience, or patience with a plan. Look, I'm not part of that saturated world of theory gurus. I show people exactly how I implement these strategies. I love seeing people take a bet on themselves and to do things properly. Yes, it'll be harder and slower in the beginning, but when it's working for you, it's a smile they can't take away from you. Here's the practical approach. Wait for further momentum in price action, then look for a pullback to retest the high of consolidation. That's when price drops to touch the previous all-time high. If the stock drops further back into phase 3, congratulations, you sidestepped a fake breakout. The stock might now move sideways for weeks, maybe months or longer. If you bought in on the first breakout, your money would be tied up for an undefined period with zero growth. That's exactly what we want to avoid. But if the stock bounces and breaks out again, that's your confirmation that the uptrend has started. There's your entry point. While there's still a small chance of a fake breakout, the odds have drastically reduced from the first breakout. With each subsequent breakout, the chances of a breakout diminish as the uptrend gains momentum. These trends can last 12 to 18 months, sometimes even longer, before the next market correction. Speaking of entry points, here's my specific approach. I like to go in above the high of the bar by at least 10% of the range of the breakout bar. So, for example, if the range for is $5, I place my entry at least 50 cents above the high of the bar. I also place my positions after the market closes using entry orders. Why? Because when markets are closed, I can take my time placing new positions, managing open orders, and double checking everything to avoid costly errors. After market close, entry orders bring a calm, objective approach to position placement. Okay, so now let's dive into rule 3, a wide safety net. Now, look, I don't know about you, but I love the idea of being an adrenaline junkie. Throwing myself off a mountain, wearing one of those flying suits, swerving around like it's the most natural thing in the world, and then smoothly landing on terra firma. It's absolutely mind-boggling, and I wish I could do it, but I can't and I won't. I'm happy watching those amazing human videos at the gym and loving the idea of it all. Taking a position with no stop loss is like you and I untrained jumping off that mountain. There's just too much risk of catastrophic failure. I'm fine jumping off a 20-foot cliff into a lagoon like I did in Japan a few years back. It was sensational, but the risk to reward was manageable. I love adrenaline, but all within reason. But when it comes to my portfolio, a stop loss is non-negotiable. I like to keep my money because the more money I keep, the more I can grow. Here's a tip. Find the misfit in sensible, because it's those who don't fit in by doing things correctly who make the money. Get to a point where it's comical to do anything else. I place a wide stop loss on every position using the average true range, or ATR, to gauge a stock's volatility. This tells me how much a stock fluctuates on average over a time period. Take GoDaddy. Its daily fluctuation over the last month is $4. For Microsoft, it is $8, making Microsoft significantly more volatile. But do be aware that the ATR can change depending on if the stock is trending or moving sideways. I then use a multiplier, say 4, to create the stop loss. For GoDaddy, that means placing the stop loss at least $16 away from the entry. For Microsoft, it's $32 away from the entry. Now, these aren't random numbers. We've created stop losses unique to each stock based on their volatility. This approach has two major advantages. First, it's wide enough to give stocks the breathing room they need to gradually move up without getting stopped out on normal pullbacks and volatility, because stocks don't just move up in a straight line. A trend structure is made up of pullbacks and breakouts. Second, if the stock does decline enough to trigger the stop loss, it's clear the market has reversed and the trend has failed. This brings us to rule 4, a risk management framework. Risks should never be feared, just controlled. You know those people who say investing is high risk? They're usually basing that on their own poor past decisions that cost them money, or stories they've heard from others' failures. Instead of taking accountability and seeking a better way, they've simply given up. Let me break this down with a real example. If you have $10,000 and that's everything you've got, putting it all on a single asset based on a hot tip or a hunch is high risk, regardless of how volatile that asset is. A stock might be less risky than Bitcoin, but there's still a real chance you could lose that $10,000 on both. And that's everything you have, that's uber high risk. Now let's flip the script. If that $10,000 is just 2% of your capital, you're working within a sensible risk management framework. You can calmly accept that you might lose that 2% quicker on Bitcoin than on a stock, given crypto's volatile nature. but it's only 2%. Here's the key. Small losses get absorbed into large winners. That's how good investing is done. Losses should be small and insignificant. Profit should be large and exponential through compounding, which will be a topic for another video. My risk management framework is beautifully simple. I never risk more than 2% per position and cap my maximum exposure at 20%. Let's say I buy 10 stocks at 2% risk each. Worst case scenario, I could lose 20%. But when I apply the 4PS method, which we covered in Rule 1, this is extremely unlikely. More typically is a mixed bag of results. Say out of the 10 stocks, 3 might stop out for a loss, 3 might break even, and 4 might return 15% each on average over 12 to 18 plus months. My typical holding period for winning trends. Do the maths with me here. 60% profit from 4 winners minus 6% loss from the 3 losers equals a 54% ROI over 12 to 18 plus months. Not bad at all. Now, here's a question I get asked all the time. What's your win rate? This question comes from the explosion of day trading, where winning has taken precedence over making profit. But investing isn't about winning or losing. It isn't about defeating the market, a battle you will lose. The abysmal failure rate of up to 95% of day traders shows what happens when you come in with a battlefield mentality. The market is vast and has little patience for those who think they can take her on and win. Good investors don't think in terms of winners versus losers. They think in terms of profit and loss. They don't battle the market, but align with her. Look at our earlier example. Only 4 out of 10 stocks were winners, giving us a 40% win rate. But they returned a solid 54% profit. We'll take that all day long. Compare that to 5 short-term trades opened and closed in a day, 4 winners and 1 loser, an 80% win rate. Sounds excellent, right? That kind of win rate gets people salivating. But, and it's a big but, that one losing trade could blow your whole account if you over-risk and have no stop loss. I could market a system with an 80% win rate and people would buy it all day long. Market one with a 40% win rate, people might think I'm a nut job. But as you can see, win rate skews the numbers. The correct metrics is profitability, regardless of win rate. A good strategy isn't about how many winners you have, but how large those winners are, while keeping losses to an absolute minimum. Think like this, and you move from a gambler's mindset to an investor's mindset. Welcome to the big league. Here's another crucial point about risk. If you have $10,000 and lose $5,000, you've lost 50% of your capital. To turn your remaining $5,000 back to $10,000, you need to double it. That's 100% gain needed. A 50% loss requires you to work twice as hard to make it back. This is why you want to work within my risk management framework. 2% per position, 20% max risk allocation. When a stock moves 2% in your favor, eliminate risk by moving the stop loss to entry and let that stock run. I'll show you exactly how to manage a winning stock in Rule 5 next. Here's the cool part. Eliminating risk on a winning stock frees up risk capacity for adding new stocks that meet our 4PS method criteria. You can build and diversify your portfolio without exceeding that 20% risk allocation. If you're risk averse, start with 10% max risk allocation and build up to 20%. Remember, the hallmark of a good investor is managing downside through good risk and exit management, and then letting profit come to us by allowing winning positions to run. And that takes us to Rule 5. Let winning positions run. When a stock is giving you money, take it for everything it's handing out. To do anything less goes against the playbook of any accomplished investor. One of the main reasons why budding traders fail to grow their money is that they take profit too early in fear that they will lose it while holding on to losing positions, hoping for a reversal. The whole approach is completely back to front. Let winners run, cut losers short. It's well known, but rarely well practiced. So, how do we let winners run? We use the daily 20 simple moving average and the daily 50 simple moving average as our guide. A profitable trend structure will stay above these levels, but periodically pull back to them to use them as a trampoline or support zone to bounce off towards new highs. This relationship between price and these two moving averages can last months. As long as the stock price remains above these moving averages, we continue to hold and collect profit. Let's look at GoDaddy. See how it's used the 20 SMA and the 50 SMA as a support zone to climb from $100 when the trend began to $150. Now, here's a pro tip. To stay in winning trends longer, occasionally, usually after a sustained uptrend of several weeks to months, the stock price will move below the 50 simple moving average, signaling the end of a trend and when you might consider exiting. However, often the stock isn't moving into a full-on market reversal, which most wrongly assume, but instead move into consolidation, a period of sideways movement. This is perfectly normal and actually very healthy for a stock. Think of it as a breather period where the consolidation will act as a base for the next leg up. Remember phase 4 in our 4PS method? It's when the stock is forming its latest uptrend and setting record highs. We like trending stocks setting record highs because there's little resistance above forcing the price down. We use round numbers as levels that stock prices tend to gravitate towards. Below $100, every $10 is significant. Above $100, every $50 is significant. Going back to GoDaddy, following the trend from $100 to $150, the stock moved above $150 and then corrected and moved below the daily 50 simple moving average. This may prompt some to exit, which is fine if that is in your trading plan. However, GoDaddy corrected to and then used the $150 round number as support, formed a base, broke out and is now at $200, still remaining above the MAs during that climb. If it clears $200, it will likely climb towards $250, continuing to use the moving averages as support along the way up. Applying patience, learning to sit through these corrections and executing a structured approach returns the kind of profit many hope for but rarely see. So let's put this all together with a real example. Deere & Co, a stock looking promising for 2025. Starting on the monthly time frame, we can see phase 1 between 2020 and 2021, a roughly 120% climb. It then formed a long-term base until last month, November 2024, which is phase 2. It broke out from phase 2 in the last few days of November, so it's currently in phase 3. To avoid a fake breakout, which is Deere & Co moving back into phase 2, I'm not entering now. Instead, I'm applying patience. On the daily time frame, I want to see a pullback to touch the previous all-time high. This is where the breakout could fail and the stock moves back into phase 2. Instead, I want to see if it bounces off support and confirms the next breakout. That bullish continuation pattern is known as a bull flag. Once the breakout is confirmed, I'll place an entry above the bar's high by at least 10% using the range of the breakout bar. Now, with a $20,000 account, for example, risking 2% means $400. The stop loss, based on the 30-day average true range of $10 multiplied by 4, gives us a $40 stop loss. Here's a quick pro tip on stop losses. I prefer using a wider stop loss, so I go with a multiplier much larger than 4. Experiment with it and backtest to find a stop loss that works for you. The goal, remember, is to stay in winning trends for as long as possible. After the position triggers, I'll give the stock time and space to either return a profit or hit the stop loss. If it hits the stop loss, I'm out with a 2% loss. If it starts returning a profit, I want to see the uptrend unfold using the daily 20 SMA and 50 SMA as support zones, pushing towards $500, then $550 and beyond. Since the previous trend lasted 12 months, I can use this as a rough estimate of how long this current trend might last. These rules help prevent large losses and turn good stocks into significant profits. But it all starts with choosing the right stocks. If you get this wrong, you will always struggle to achieve consistent returns. Watch this video to learn how to shortlist the best stocks and aim for profits of 800% or more in 2025.